Alrighty guys, what is going up? I hope you guys are all having a great and amazing day today. Now in today's video, we're going to be talking about how you guys should invest $1,000 into the stock market in 2021. So I hope you guys enjoy it. If you get anything in value, hit that like button because it really helps me out. So make sure you guys smash that like button if you get anything in value. If you have any questions or concerns, go ahead and ask them in the comments. And if you guys want to learn more about investing in the stock market, go ahead and check out my course. And you guys can use promo code DIVIDENDS to get 50% off. So at least check it out. So now guys, let's jump into it. Roll the intro. Let's go. Come on. Bang. So now we've all been told to invest in the stock market to get wealthy, but what is a stock? Well, when you guys buy a stock, you represent a very small ownership in that business. So if you buy one share of Coca-Cola and Coca-Cola makes more money, well, the stock will become more valuable and you will make money off that share. But if let's say Coca-Cola loses money, that share price will go down in value and you will lose money that way. Now, when a company makes so much money, they will pay you. This is what you call a dividend. A lot of people love dividends because it is a perfect passive income stream. It requires a little maintenance to buy the stock and then you could pretty much get paid for life. Now, there's multiple different dividend stocks out there. There's dividend aristocrats, dividend kings. Now, the difference between the two are very simple. A dividend king is when a company has been paying a dividend for more than 50 years. So these companies you can pretty much count on cash flow coming in, and a dividend aristocrat is a company that has been paying a dividend for more than 25 years. In my opinion, both of them are very strong. You just want to make sure the company has a low payout ratio. Now, a payout ratio is just a ratio to judge how much a company is paying out in their earnings. So if a company pays out 100% in their payout ratio, that's not very good because there's no leftover money to grow the business because we are long-term investors. So I'm sure you guys have heard of an ETF. This is an exchange traded fund. Now, I know that sounds very confusing, but it's not. It's just pretty much a pool of stocks in a low-cost ETF, so you don't have to buy full prices of all those stocks. You can just buy a low-cost ETF that has a multiple holdings in it. Now, the difference between a stock and an ETF, stocks are more risky, ETFs are less risky. That's pretty much the major outline of it. The reason why is because if that's say you own an ETF, you could have 500 holdings in it, and if that's say 10 stocks go down and the rest go up, you still make money. But with a individual stock, if that one stock goes down, you lose money. So now I know I'm saying a lot of terms, and if you guys have any questions, ask them in the comments because I know I'm going pretty fast. But don't be afraid to just invest in ETFs. You know, a lot of people hate ETFs because you can't make any money. That is not the case, guys. ETFs are perfect for beginners because you get a pool of different stocks in it, and really the risk level is very low, and on top of that, you can get dividends and compound your money a lot faster. So now that we have a good understanding of ETFs, stocks, dividends, the next step is picking a certain account type. Now there's multiple account types out there. There's a standard broker's account, there's IRA account, there's 401ks, trust, there's spec IRA. There's a lot of them out there. But honestly, a traditional account, a traditional broker's account will be just fine for pretty much everybody. Or if you guys want a long-term retirement account, I personally would recommend a Roth IRA. Really, Roth IRA are perfect. There's a lot of tax benefits behind it, and you don't pay any taxes when you retire. You pay them before when you're a lot younger. So I personally think a Roth IRA account is more of a retirement account, but a standard broker's account will work just fine. So now I'm sure you guys have heard of the market. You know, everybody says, oh, the market's going up, the market's going down. Well, what does that mean? Well, they're talking about the market indexes. There's multiple market indexes out there. There's the S&P 500, there's the Dow Jones, and the NASDAQ. So the difference between all of those are very simple, and it's nothing to be worried about. The S&P 500 is just the top 500 companies out there, okay? Weighted by market cap. Now, the leader of that is Apple because it has the most market cap. Now, the pro of this is it's been around for more than 90 years with a 9.8% return every single year. Perfect for beginners who just want to sit back, relax, and not even do anything. In my opinion, I think everybody should be invested in the S&P 500. So now I'm sure you guys have heard of the Dow Jones. Well, the Dow Jones is pretty much just the 30 most traded stocks in the New York Stock Exchange. So this has a lot of awesome companies. You get paid dividends. It's perfect for beginners too. Now another index is the NASDAQ. In my opinion, the NASDAQ is that new Ferrari that everybody wants. These are a lot of tech stocks. These are companies like Amazon, Microsoft, and a lot of those. So honestly, all of them are fantastic investments and I would highly recommend them. So now for the money question, how should you diversify $1,000 in the stock market? So like I said, I would highly recommend the S&P 500. So starting off, I would invest 40% or around $400 in the S&P 500. This is something you will never have to touch. You can compound your money very, very fast. And just to put this out there, with all of your dividends, especially being young, make sure you guys have a broker that offers DRIP. So all the dividends you get, you're just gonna reinvest them right back into the company. This is why. You guys can clearly see the difference between reinvesting your dividends and not. So make sure you guys have a broker that offers DRIP. You will not regret it. So now the second investment that I would have is 10% going into an ETF called VIG. This is Vanguard's High Dividend Appreciation ETF. So what this is it has a ton of awesome holdings from Microsoft, Johnson & Johnson, United Health. All these companies are either dividend kings, aristocrats, or companies that have been slowly increasing their dividend payouts. This, in my opinion, is a perfect investment so you guys can sit back, relax, and get some cash flow coming in through your portfolio. So now the third investment that I would recommend is investing 10% into the bond market. And I know a lot of you are saying, Carter, you can't make any money in bonds, it's not worth it. Well, what I do is I almost use the bonds like a hoarding of cash. So if that say something becomes very, very undervalued, I will sell my bonds and put it in the thing that's undervalued. Now I did this in March when the whole market crashed and the ROI, the return on investment, was a lot higher than just holding those bonds. But why I hold those bonds in the meantime is because it almost acts like a defense in your portfolio. You get a growth at around 5% a year and you get a dividend payout of around 3% a year. So it's a perfect investment, so you guys can almost use it like a hoarding of cash, waiting for something to become undervalued. So you always have cash ready for things that become undervalued. Now the fourth investment, I would invest around 30% of my money into blue chip stocks. So blue chip stocks are companies that are worth hundreds of billions, if not trillions of dollars. These are companies that you and I know of. These are companies like Apple, Amazon, Microsoft, Johnson & Johnson. Now you guys could invest into blue chip stocks, and I would recommend investing into some dividend kings. So these are going to be companies that have been paying a dividend for how long? Yes, 50 years or more. So these are going to be companies like Coca-Cola, Johnson & Johnson, something that you can start compounding your money. Now that is 30% going straight into it. So now that you invested into a lot of the more secure and stuff that you don't really have to worry about, last, you're left with 10%, so where should you put this? Well, in my opinion, you could invest into some riskier stocks. So these are going to be companies that have a very, very high risk, high reward. So companies like Plug Power, Workhorse, and a lot of the other blockchain companies that a lot of people have a very, very high risk, but also a high reward. So if you're right on one or two of them, the ROI is very, very large. But obviously with all of your investments, you want to make sure you're diversified, you want to make sure you have DRIP and a commission-free broker. It's all very, very crucial so you don't get charged any nasty fees. So make sure you guys don't use Acorns, handle it all yourself. You guys will not regret it. Also, I personally use M1 Finance, and I'll put a link for my broker down below. So if you have any questions or concerns, go ahead and ask them in the comments. But that is pretty much how I would recommend investing in 2021 so you can get the highest ROI on your money. So I hope you guys enjoyed it. Smash the like button. We'll see you guys tomorrow. Take care. Remember to stay happy, stay positive, and stay safe out there. Take care, everyone. Bye.